It all comes down to this. I'm your host, Steve Van Metre, and thanks for joining me today. This next week, stocks face a critical test where if they pass, the melt-up is in full effect. They fail, and it's a massive meltdown. And what does it all come down to? You got it. The machines. Let's over to Goldman, where we picked today's story up, who notes in their tactical flow of funds report that it's max pain to the upside that investors will experience since many people are in cash or short the market. Let's take a look at the volatility controlled or insurance rebalance. They note that Goldman notes that these strategies are now the largest source of incremental demand. And this is a case I made last week that if volatility continues to fall, these machines will buy. They know that their current exposure is 85 billion long. Their 5-year average is 146, meaning that as volatility continues to fall, that these machines will buy even more. So what we need to be looking for as we get to this critical test is to see if these machines are going to get any support to push past and put the melt up in full effect. Here we can note that risk parities, they've been re-leveraging too, and given the decline in long realized vol, they have them in the second percentile of exposure, current position 61 billion long versus 1-year average of 85 billion, suggesting that these machines too can keep buying. And how about the CTAs, which is what we really like to focus on in our Sunday show? The equity and fixed income, they're both re-leveraging. That means coming off their short positions, and CTA strategies look to take out their long-term threshold at 4,058 after adding 150 billion, one of the largest re-risking in their data set, as all eyes are on the 200-day moving average just above at 40.62. And how about buybacks? Corporate demand remains very strong, according to Goldman, ahead of the 1% tax change coming next year. $6 billion worth of daily demand all the way through December 12th, putting us at the best 2-month period of the year for corporate tax flow. So what you're seeing here is there's a lot of case from buying coming as we face the 200-day moving average, the critical test, and this is where it all comes down to the machine positioning. Let's take a look at Metre and TD Securities. Metre, no major updates. Their balance is still holding somewhere over that 4,000 mark, looking to cover their shorts. They remain deeply short. Same with TD Securities. They're coming close to this 200-day moving average, and it all hinges on that one critical test. Now, before we go look at this, I wanted to mention we do have a sponsor for today's show, and many of you were excited about the Zacatecas silver that we talked about a previous week or so ago, and I said that if another one comes across my desk, and this one's been the most requested one, just so happens we've got it, and if those of you are wondering, I did take a position in Zacatecas silver that following Monday, and I'm going to do the same here, or the following day that show aired on Monday. I'm taking a position in this one. Let's take a look at the test. We'll get to that later in the show. And what do we note here? CTA positioning, this S&P faces a critical test at the 200-day moving average, and CTAs will continue to short cover as it approaches this 200-day at 4,057 and will accelerate their short covering above it, and this will reflexively send volatility down, which is a key point that you see all these other strategies as volatility falls, they buy. Let's take a look at the S&P 500 here and just see how close we are. You can note there it is, the 200-day moving average at 4,056.91 as of the close on Friday, and you can see we're right below that here. As this pushes higher, we note that this is a common place that it gets retested. You're going to see some increased short covering. If you see a sustainable close above the 200-day moving average, you're going to see more short covering. As you get over 4,200, you're going to see that short covering accelerate and then eventually flip into a long position, and you're going to see those risk parity, you're going to see those vol control strategies layer into deeper longs. And the reason this is such a critical test for the S&P is because when you look at major tops, you'll get a one-time shot at it, you'll get another shot at it, but when you see it get rejected, if you see it come up here and get hard rejected and sell, you're looking at a massive meltdown. You get to move above this, and the case now becomes a melt up, and that's something the market is absolutely not positioned for or expecting. And now let's take a look at the momentum signals, because they're validating that this thing can go higher, a whole lot higher. Let's look at the SPY. We know momentum is positive. The RSI sitting at 62. MACD's bought a positive cross. Momentum Timer Pro, 28 consecutive daily buy signals, and picked up its golden signal. We gave that to subscribers last week with the 3-month window hitting a minimum. And notably, we've got a Black Friday special. Go to marketsinsiderpro.com. There's a link in the description. The sale price is already embedded in the link. It's half off in perpetuity. It's all there. You wanted it back. There it is. Go check it out. Let's continue with this because we said buy it open on November 8th at 381.11. Now still up at 402.33. We've got some upside targets still to go. And if these are breached, it's going to go a lot higher. Downside is rather minimal here. Let's take a look at the SPY and what do we see here? Of course, we know as we zoom in, the 2-year volume profile is above, right at that supply zone. 200-day moving average becoming the initial target. Breakthrough there, break the supply zone, and now you're looking at new all-time highs potentially. But look at this on the 6-month window. Notice that the buyers are right beneath current price, suggesting that buyers are very strong here, and this is likely to hold as support, and that is a key point in today's show. The support is strong for the market. The machines just have to push this a little bit higher. You get a break over the 200-day, and you watch people will come screaming back in. And now let's take a look at tech. And what do we see for the tech stocks is their momentum is positive as well. The RSI is at 56. MACD's got a positive cross. Momentum Timer Pro, 10 consecutive daily buy signals. We flagged to buy it open on November 11th at 282.56. We note that the 200-day moving average also remains its upside target. Let's take a look over here and see what QQQ's up to. And again, look at the support underneath price here. And this is critical. This is what you want to see in a bottom. You want to see people coming in, buying the dips, and then forming a nice top here for price to break through. It came up, hit a supply zone, retouched there, came into the supply zone. Buyers were found, got rejected the second time. Buyers came in. Now the question is, you break this 100-day moving average, you've got the 200-day to the upside, and you've got a lot of clean air for the market to run in above that. And again, this is something that's not being priced in at all by the markets. Now let's take a look at the bond position here. What do we see that with bonds? Of course, no major change there from Nomura or TD Securities, putting us at the same note as we had last week. You watch the 10-year Treasury, falls below 3.1% before you're really going to see any kick from the machines occur, and that will be a significant move because, again, you'll start to see rates fall, and that's a boost for tech. Those two tend to work together here, and this will just be a sign that the market's saying, hey, things are getting better, even if the economic data doesn't actually validate it. Let's take a look at TLT here. And we got the RSI at 62, MACD on a positive cross, 10 consecutive buy signals. You know, I mentioned for dip buyers last week, to trade up on the 1-month signal. Now I'm going to add and say, if you're still not comfortable, and that's okay, this is still very early signal for a trade. Wait until the 1-month flips to buy max and the 3-month is sell mid. If you're still kind of holding off, no problem, but don't be in a rush. Wait for the signals to validate the upside target at the 100-day moving average. I expect rejection here and then a pullback. I've noted last week the 50-day, we broke right through that. Downside target at 97. And of course, we see here on TLT, a nice bottom starting to form, some volume beneath here. There is likely to be a rejection at one of these moving averages. You notice that the 6-month volume profile is up here. This is the key points. Got to break here. Got to get to that 200-day moving average, and the machines don't kick in until somewhere right around this 110 level. So we've got a ways to go before that actually happens, and then you'll see some acceleration. Now let's talk about gold here, because we remain bullish on gold for a lot of reasons. We talked about last week that how the CTAs are just on the verge of cutting their shorts back, and sure enough, we see that from Nomura. The short position that they need to cover is just above current price. Same with TD Securities. Be watching that 1760 price level for the next round of short covering, and that will boost not only gold, but as we talked about, gold miners. How about looking at the momentum on GLD? We know that the RSI is 61, is positive on the MACD. Momentum time pro is 14 consecutive buy signals. I still maintain I wouldn't go out and buy a position in this if you're looking for a trade. Wait till you get a close over that. Let the machines kick in and just fly with them on the way up. Upside target being the 200-day moving average, where I'll expect rejection. Again, the 200-day moving average is often a sign of initial rejection before you actually see the market actually then move higher. So it needs to test it, and then break through. And if you're really not in a rush, don't be. Wait for it to break that. Now let's look at the charts here, and we'll see what we've got on GLD. And it looks pretty good because here again, you're seeing the same setup here. You see price came down, buyers came in, price came down, buyers came in, price came down. Everyone said that's it. Buyers came in. Look at the 6-month volume profile right at the 100-day moving average, providing some support here. Again, I think you get a rally up to that 200-day moving average. And you here on the 5-year chart, you can see that's where all the sellers are at. You can actually make the case here, as we've talked about on this show, for an everything rally where you see not only stocks rise, you see bonds rise, you see metals rise, you see everything go, because the machines start to push everybody up. And then what happens is all the people on the sideline or who's short, they have to start coming back into the market, and it drives it up again. And then you get the Fed backing off as the economic data shows. And we can see this in the past where you get these big swings up in the market before the real bear market kicks in. And now let's talk about our sponsor, because I want to mention this is a metal that many of you said, hey, you need to, or that you need to look at. And you guess what it is? Well, it looks like this. If you've guessed uranium, you've got it right. And what is the case for this? Well, nuclear energy is facing a critical test as well. You may not know this, but 20% of American households get their power from nuclear, and it might shock you. Do you know where we get our uranium from? Nearly 100% of it. Hope you're sitting down for this. From Russia and Kazakhstan. That's right, hardly any from domestic production. And you can only imagine, and when you think about what's going on with Russia and Ukraine, what politicians in the US are not going to want to import from Russia or Kazakhstan due to the dangers of just those regions and what's going on politically, putting the focus now on to domestic production. And that brings us to our sponsor for the day's show, Uranium Royalty Corp. Let's take a look here. And what we notice, they're the first and only pure play for uranium royalty company. And now you're saying, well, what is a royalty? What is all that? How does all that factor? We'll get to that in a moment. But I want to go back here and just put their symbol back up in case you missed it. It's UROY on the NASDAQ, UROY. On the TSX, it's URC. Now let's take a look at the political case for uranium, because it's huge. Right now, there's bipartisan support for nuclear energy. We can see both Democrats and Republicans are in favor of it, because what is the plan here? We're supposed to go carbon-free by when? 2035. And where are they going to get all this energy from? They're going to look to nuclear, particularly based on what's gone on with Russia and the oil shortfall. Your nuclear is going to come back in a big way. And many of you have told me, Steve, you got to look at this. Well, here it is. Let's continue and look a little deeper here. The Biden administration wants congressional approval allowing the DOE to purchase, get this, 4.3 billion of uranium, but not any uranium, domestic production here, domestic uranium. That will send the price skyrocketing. And of course, they want to have a 1.5 billion strategic uranium reserve that will be likely rolled into that program as well, again, putting demand for domestic production. And on top of that, they're also having the DOC amending the Russian suspension agreement to limit and reduce imports from Russia up to 75%. So we're going to need to get uranium from somewhere. Again, it's all going to be focused now on domestic production. And again, that will send prices way higher. Now let's talk about this royalty thing, because Uranium Royalty Company is actually the only royalty provider in this space. No one else is doing this. They have 15 royalty agreements already in place. Now you're saying, Steve, what is this royalty? How does it matter? How does it factor here? Why is this such a big deal for you, Roy? Well, let me tell you. Now, when a miner or someone who's got land that's got proven production in it, proven reserves, and they want to develop it, well, they tend to often go to a bank and borrow money to then produce the land, turn the mine on, do all the things that they need to do. But can you imagine going down to the bank and saying, hey, I want to dig for some uranium? They don't have a clue about it, and they're often likely to reject it or make very unfavorable terms. And that's where Uranium Royalty Company steps in. They provide the funds. They're not the ones that dig the ore out of the ground. They're the ones that provide the money to these companies. In exchange for that, they get a royalty. As uranium comes out of the ground and gets sold, they get a cut of the profits. And that's right. That means, of course, they have 15 of these. And the more of these royalties they have, the more profitable UROY is going to be, because once they pay back their initial money that they give to provide these companies, it's pure profit rolling in after that. It's a great deal. And again, Uranium Royalty Company, symbol UROY, the only company doing this, and that's what puts their stock in a position to head a lot higher. But there's another factor here as well. Unlike the banks, who really have no ability to help these companies out, UROY has a vested stake, and they have a fantastic management team, because when you get UROY, you get money from them, you get their full experience of their management team. And that's what's really interesting about Uranium Royalty Company. Again, nobody is doing this anywhere in the space, and that's what makes them a really great pick here, because you're getting not only a specialist, their only player that's doing royalties in uranium, but they're tied to all the miners. They got 15 of these royalty agreements. They're going out and getting more. And that's why analysts saying their stock is poised to rally. They're talking a price target of $5.70, which is huge. It's more than double where it sits now. But as you know, on this show, we don't just take analyst views. We actually want to look at the stock and run our own analysis of it. So let's take a look at Uranium Royalty stock and see what the projection is here. Do we agree with them or not? And when we're done, you'll see why on Monday I'm adding this to my portfolio. And here you can note that over the last 6 months, we have the volume profile here. We have the RSI. It's sitting at 54, so momentum is positive and building. We can see the MACD is looking like it just wants to cross slightly to the downside, but look where the volume is. You see a lot of purchasing all below the current price of 267. It's got support sitting right underneath, and that's what you really want. And you'll note now the 200-day moving average sits above. Now let's go out a little bit here and see how far we need to go. Yeah, there we go. We're on the 2-year chart, and notice how the 200-day moving average is a point of resistance to the upside. But you'll note that the 100-day moving average is bottoming and starting to turn upward. The 50-day should flatten soon, as shown in green. And the 21 days got a positive cross on the 50 and about to make a positive cross on the 100. You get another test of that 200-day moving average and it breaks it. I want you to see how quickly, when you look at these supply zones, so we have a supply zone right down here around this, say, 243 to 280 range or so, right in here. And notably, when it breaks out of this, look how fast price moves either to the downside or upside. It's because it's moving into another supply zone. The next supply zone is at 406. Analysts say that this can go higher, and sure enough, it can. You get any news out of Washington, D.C. that they're going to support uranium in a big way or do some legislation, you watch, the price will skyrocket and UROY will lead the way. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.